Okay, so we're going to look at income summary and how it works in the accounting process. So with income summary, at this point, we have gone through and we've posted our journal entries to the various accounts. We've done the journal entries here. We've posted them to the T accounts, come up with our ending balances in the accounts. We've done our trial balance, which is all the different accounts with their total debits and credits, and so forth. And now, after we do our financial statements, we're going to do our closing entries. Okay, the purpose of our closing entries is going to be to close out all of our revenue and expense accounts. So we leave all the balance sheet accounts as they are. So your assets, liabilities, and things, they don't change. But all of your revenues and expenses are going to be closed. We call them temporary accounts. And they're going to be closed into your retained earnings. So basically everything altogether all ends up in your assets, liabilities, and owner's equity accounts. Does that make sense? Okay. So in order to get all of our revenues and expenses into our retained earnings account, what we need to do is we use this account called income summary. And essentially, income summary is going to be the same in total value as our net income, just as a rule of thumb. So say I have, let me pull up green, we'll go green. So say I have my income statement here, and I have revenues of, let's say, $10,000, and I have my expenses, which include rent of $2,000, insurance of $500, and travel of another $500. Okay, my total expenses are going to be $3,000. And if I take my revenues and subtract my expenses of $3,000, then my net income is going to be $7,000. Does that make sense, right? So when we close all of these accounts, at this point, we have our revenue account, which has a credit balance of $10,000, and we want to get that down to zero. So in order to do that, we have to throw in a debit of $10,000 here and get that out. So with this adjusting entry to the income summary, we're going to debit revenue by $10,000. Normally, to get revenue or to record revenue, we're going to credit it because it's a normal credit balance. So we debit that, and then all of our expenses we're going to credit in order to close those. So a debit to revenues and a credit to our expenses. So we'll credit rent for $2,000, insurance for $500, travel for $500 here. And remember that our debits and credits have to balance. So the difference between the two, which is this net income, we're going to plug in at $7,000. And instead of calling it net income, we just call it income summary. Okay, so we have a new T account, income summary, which has a credit balance of $7,000 here. Okay, an income summary, just like the expense and revenue accounts, is also a temporary account. So after we've closed all of our revenue and expense accounts here, we're going to do one more entry where we take income summary and we're going to debit it for $7,000 to clear it out. Those cancel out. Now we have a balance of zero. And the credit side is going to be retained earnings. For $7,000. Okay, so that ends up increasing our equity account on this side. here. All right, one last hint that I got from a student in class today is basically remember to read, R-E-I-D. This is looking at the order of the closing entries here. So first we close our revenue accounts first, then we close our expense accounts, then we close our income summary, and finally we're going to close out our dividends. So our dividends aren't going to be included with our income summary. They're a separate item because they are basically affecting equity directly, because we're taking this retained earnings here and we're distributing it to our owners, to our shareholders, and so forth.